I'm in Paulson and I don't have my mic. It's usually on the table, but it doesn't seem to have been delivered today. So if you can get it for me. Paulson, the auditorium, UC50. Yeah. Okay. It's one mic, but it's the over the head one. It's specially for this class. So. Okay. Waiting for my clock. So while we're waiting, did anybody figure out the answer to this question? How much of the cost in your out of the 300 million DNA cost, how much is fixed and how much is variable? Anybody want to give that a shot? How you answer the question? What's the clue when something's variable? What gives it away? As revenue change, it changes too, right? That's the essence of variable.
Professor, sorry for interrupting. Your mic is not working. We can't hear you online.
Oh, I can't tell them. I don't have a mic. Okay, so the key to something being variable is it moves with revenue. So if you look at, I've set this example up as a very simplistic example. And if you look at what happens as my revenues go from $1 billion to 1.2 billion, my G&A cost goes up 20 million. From 1.2 to 1.5, it goes up another 30 million. So for every $100 million increase in revenues, my G&A cost seems to go up 10 million. So my revenues drop to zero. It's an extreme scenario. What's going to happen? My G&A cost is going to drop by 150 million, right? I'm still going to be left with 150 million in G&A costs. In year 3, half of my G&A cost is going to be fixed and half is going to be variable. But as the company grows, guess what's going to happen? The variable cost is going to become a higher percentage of your total cost. And that's what economies of scale create. As you get bigger, that's how economies of scale improve margins. Your fixed cost stays constant. I'll give you one example of how this plays out in the streaming business. I mean, think about the two biggest streamers in video and audio. Netflix is the biggest video streamer. Spotify is the biggest audio streamer. Very different business models in how they get content. Netflix makes its own content, buys its own content, then goes and signs up subscribers. So the content cost becomes almost a fixed cost. So when you sign an additional subscriber, it costs you almost nothing in terms of content. Spotify is a different business model. Does anybody know how Spotify pays for music? You've probably seen some of the fights between Taylor Swift and Spotify and the artists. How does it pay for music? Based on the number of times your music gets streamed. So if you have a song on Spotify and nobody listens to you, you get nothing from Spotify. Every time somebody listens to a song, you get like 0.038 cents or something like that, some agreed. Do you see what that makes content costs for Spotify? As they grow and they get more subscribers listening to more music, the content cost will actually grow with the subscribers and the revenues, because the more people listen, the higher your cost. What does that mean? If you value Netflix or you value Spotify, when you look at Netflix, Growth is good. Economies of scale kick in. How much they kick in, we can debate, but your margin should improve as you sign up more subscribers and get bigger. Whereas for Spotify, it's going to be much more difficult to improve margins as you grow because you've made your biggest cost. And remember, I think 77% of the total costs come from content. That cost grows as you grow. It doesn't make Spotify a bad company, it just makes them very different companies. So I'm going to leave you with one final way of checking to see whether something is incremental, because you're going to run into this question when you look at your case. To check to see if something is incremental, ask two questions. What will happen if I take this project? What will happen if I don't take this project? The difference is the incremental effect. Let me repeat that again. Ask what will happen if I take this project? What will happen if I don't? To trace out the effects completely, look at the difference. So I'll leave you with an anecdote to kind of explain how this difference plays out. For a long time, I used to do these training programs for investment banks to teach, especially the undergraduate analysts were hired. So I spent my summers basically going from investment bank to investment bank. And by the time it was all these programs would be crunched up in August. So by the time you got to the end of August, it was exhausting. I didn't even know which investment bank I was in or who I was talking to. I was saying the same thing over and over again. So I think this was a 3-day program. I forget the name of the investment bank. And they didn't have a room big enough for their entering analyst class. So they hired this room. I think they got a hotel room. It's one of these huge ballrooms. And there were like 300 analysts in the room. We were doing this compressed version of a corporate finance class. So we were talking about allocated costs and incremental costs. Everybody was bored, including me. But there was this one person who was setting up the food outside, the catering, who stood at the door, and he was the most interested person in the room, and that includes me again. So the end of the second day, all the analysts stream out, they're just done. And he comes up and he says, I have a question, I've been listening to you all day. He says, I'm from Guatemala. And every year I fly back home to visit my family. Cost me about $1,000 round trip. And every year when I go back home, I buy seconds from the Gap or the Limited, clothes with small imperfections to them, which I can buy cheap. It costs me about $800 or $900 to get these clothes, but I can sell them once I get there for about $1,400 or $1,500. He says, I've talked to some of my friends who are accountants, and they tell me I should stop doing this. You see how the accounting mind works, right? It costs you $1,000 to fly round trip to Guatemala. You make about $500 by selling these clothes. If you did an accounting statement, you have a net loss of $500, you should stop doing it. But he said, I feel like I should keep doing this because it feels like I am actually making money. So I asked him the question. What's the question you need to ask him to see if he's making money or losing money by buying these clothes? Are you going to go back to Guatemala anyway, right? He said, of course, and my family's there. I've got to go back every year, which makes that cost a non-incremental cost. You're going to do it whether you sell the clothes or not. At least this way, you're reducing your cost from $1,000 to $500 by doing something on the side. Think of how many times companies shut down divisions because they're losing money. Seems like the logical thing to do, right? But when you think about how losses are calculated, they're calculated based on accounting statements. So if I'm allocating headquarters expenses to a division, and those expenses are large, and you end up losing money as a consequence, shutting down your division is not going to get that money back. So incremental is all about asking the question, what will happen if I take the project? What will happen if I don't take the project? Any questions on incremental? So think about any kind of expense you have and ask yourself, will it happen anyway? And if the answer is yes, remove it from the analysis because you don't want to reject something or do something based on something that will happen anyway. Which brings me to the third and final piece of getting a good return. So we've talked about going from earnings to cash flows, from cash flows to incremental cash flows. Let's talk about time weighting cash flows. Sounds sophisticated, but you know what time weighting is? It's just discounting. The old days when you got finance textbooks, towards the end of the book, there'd be like 20 pages of present value tables. Before you had calculators, here's how you computed present value. You go into that table and list out years 1 to, I think, 50, different discount rates. And it'll give you how much a dollar was worth in year 1, year 2, year 3. So you can see a dollar with a 10% discount rate would be worth 91 cents in year 1, 82 cents in year 2, and you could go all the way down. That's weighting. Basically, it says a dollar today is worth a dollar, but a dollar in 15 years is worth only 27 cents. Discounting and compounding just create the time weighting we need. So all you need to do to create time-weighted returns is to discount cash flows. Now, of course, we live in a day with PV, buttons on calculators and present value functions in Excel. And nobody actually uses present value equations anymore. But I think it's still useful to think about what's going on behind the surface when you hit that payment button on your calculator. In fact, if you look at the kinds of cash flows you will run into in business, there are only 5 types of cash flows. Everything will fall into one of these 5 buckets. The first is a single cash flow, a simple cash flow. So if I told you you can make $100 million 10 years from now, that's one cash flow 10 years from now. Computing the present value just takes 100 million and brings it back to today. That's the present value equation. I could also give you a cash flow that's an annuity. If I told you, right now we're in the middle of a lot of big Major League Baseball contracts being signed. So if you look at, I think, Trevor Story signed with the Red Sox today, 6 years, $161 million. That works out like 27 million a year. So if I told you can make 27 million a year for the next 6 years, that's a big contract, no matter how you slice it. But that contract is really not worth 161 million because it's the present value of the 161 million that comprises the contract. I heard the Yankees are thinking about offering a contract to Aaron Judge. It's for 175 million. But at least based on what I'm reading on the contract, 38 million is going to be deferred and paid in like 10 or 15 years. You see why teams do this? Because it lets both sides walk away claiming to have won, because the player can say, look, I got the biggest contract in history, 300 million. And the team, by deferring the payments by 10 or 15 years, makes a present value of the contract only 150 million. When you have an annuity, that is the present value of an annuity. If you don't trust me, take your calculator or your computer, do the payment for the present value function in the calculator, then use this equation and make sure you get the same number, because you should. It is based on the assumption that your first cash flow happens 1 year from now. Why all present value equations are built on that presumption. You got to wait 365 days to get your first cash flow. So you got a single cash flow, an annuity. Most of the cash flows you're going to run into is going to be either one of those or a combination. So if I give you a bond, there are 2 kinds of cash flows in the bond, right? There's the coupon, which is an annuity, and there's the face value, that's a single cash flow. The value of a bond is the sum of the present value of the coupons and the present value of the face value. There's another variation on the annuity formula that you almost never see, but actually it's a very useful formula. Let's assume you own a gold mine. You expect to make $1 million next year, but you expect the price of gold to go up at the inflation rate for the next 25 years, 2% a year. So you're going to make $1 million growing at 2% for the next 25 years. That's called a growing annuity. A growing annuity because the growth rate is fixed and there's a finite period. Now, there are 2 ways you can compute the present value of that growing annuity. One is you can take your Excel spreadsheet, go million, 1.02 million, do the whole cash flows for 25 years, discount each one back and add up the numbers. That'll always work, but it's tedious. Or you can use this growing annuity formula where you put in the 2% growth rate and whatever discount rate you want and compute the present value of a 25-year growing annuity with one equation. Again, if you don't believe me, try it out in an Excel spreadsheet. Do 25 years of cash flows, take the present value, or try the growth. Using when would I ever need a growing annuity? Let's assume I have a project, 10-year life, growing at the inflation rate. The cash flows, the real cash flows might be fixed, but the nominal cash flows grow at the inflation rate. You got a growing annuity. And then I'm going to come to the last two variants of cash flows. And these freak people out for a very simple reason. Forever is a really difficult concept for any of us to deal with. Why? Because we know none of us is going to be around forever. So when I tell you, I have this security that'll pay cash flows forever, your first reaction is, I don't care, I'm going to be dead in 50 years. But securities can outlast you. In fact, the British and the Canadian governments, until about probably 100 years ago, used to issue bonds called console bonds. Have you heard of console bonds? A console bond, I tell you, you're going to make a 2% coupon rate. The face value is 1,000, a 2% coupon rate, which means $20 in coupons every year forever. So unlike a regular bond, which has a maturity date, console bonds last forever. I don't think either government does it anymore. But if you buy one of those bonds, you get a cash flow that's fixed each year forever. It's one of the simplest cash flows to take a present value off, because if you have a cash flow that lasts forever, you take the cash flow, in this case, 20 million, you divide it by whatever you think is the right discount rate for the cash flows. Let's say your discount rate is 1%. You say, I'll accept 1%. If you get $20 a year, every year forever, with a 1% required rate of return, you'd be willing to pay $2,000 for that security, 20 divided by 0.01. If a perpetuity freaks you out, a growing perpetuity should really freak you out. Because what if I told you can make $20 growing at 2% a year forever? The present value of a growing perpetuity is the expected cash flow next year, that's always the case, divided by the difference to your discount rate and your growth rate. So if your discount rate is 8% and your growth rate is 2%, it'd be 0.08 minus 0.02. We act like we invented these equations in finance. You know, the growing perpetuity equation is just the present value, it's just sum of an infinite series. Mathematicians solved for it 200 years ago. We stole it. We act like we invented it, but it shows up in every valuation as the terminal value equation. But for a growing perpetuity to work, that growth rate has to be set forever, which also means it comes with constraints, right? If I set a cash flow growing at 8% a year forever in dollar terms, I'm asking for trouble because the economy is growing at only 2%. Letting something grow at 8% will cause the cash flow to blow up. It'll become the economy, and then what? Everything you run into, it's amazing. 80% of finance is present value. We dance around it as much as you want, but everything you see in valuation, we're drawing on these present value equations. So when we talk about time-weighted returns, we're talking about bringing these cash flow concepts, the discounted cash flow concepts, into the project analysis we're doing. So with that structure, let me give you the two ways in which you can compute time-weighted incremental cash flow returns. The first is called net present value. What do you do in net present value? You take each cash flow, you discount it back to today using a risk-adjusted discount rate, which is what your cost of equity or cost of capital. You add up the present values, and you get a net present value. And if you have a net present value, the rule in investing is very simple. If your net present value is greater than 0, even if it's only $1, it's a good project. You know how difficult that is for many people to grasp? You have a $10 billion project, and they say if your net present value is $1, you should still accept the project. It doesn't seem to be enough, right? So how would you explain to somebody that a net present value of $1 on a $10 billion project is still a good project? Why are we accepting just $1? Or are we just accepting $1, or are we getting more than $1? What does it mean when the net present value is $1? Yes?
We are expecting our investment to grow at the hurdle rate.
We're going to make, so if your cost of capital is 10%, and I say you're going to make a net present value of $1, you're making 10% plus $1. Would you rather make $1 billion? Of course. But if the choice is between $1 and nothing, I'll take the $1. So net present values, very simply, you discount back at your hurdle rate. What do you get as a net present value is to be greater than 0 for it to be a good project. But as I said, lots of managers do not intuitively feel comfortable with net present value. And here's why. I don't know how many of you have investments in your portfolio, but when I ask you, how much did you make last year on your portfolio? You don't give me a dollar number, right? You give me a percentage number. I made 18%, 15%. We tend to think in percentage terms because it's more easily relatable and comparable. So the second variant on time-weighted returns is to give you a percentage time-weighted cash flow return. What does that mean? You give me your cash flows, you tell me what you initially invest. I try a discount rate. Let's try at 8%. I come up with a positive number. I try a higher discount rate and a higher one until I come up with that discount rate that makes my net present value 0. That's called an internal rate of return. You're saying, what do I do with it? You still have to compare to your hurdle rate. You're not alleviated from that responsibility of having to come up with a hurdle rate. But now I give you a percentage number. You can compare it to your hurdle rate and say, I can make 11%. My cost of capital is 9%. I'm going to take the project. We'll talk about when the two rules might give you different answers in a little while. But for the most part, they're both time-weighted. They're both incremental cash flow based. They share a lot more in common than they do with return on capital or any of the other approaches you see in investment analysis. So I'm going to apply both these approaches to my Disney theme park. But before I do that, there's one loose end I want to tie up. Remember when I showed you the return on capital for the project of 4.18%? It was lower than the cost of capital. But before you pulled the trigger and said, don't take the project, they said, wait, because I stopped after 10 years. And this project potentially could go on for 25, 30, 50, 60 years. And with accounting return, all I could do was wave my hands and say, don't do anything right now. But with cash flows, there is something I can do to put closure in year 10 and not ignore what happens after year 10. So let's assume that I go back to this project of cash flows in year 10. And then I say, you know what? Theme parks last a really long time. In fact, I'll make an extreme assumption. It's going to sound extreme, that this project lasts forever. I know nothing lasts forever, but let's go along for the moment. And I'm also going to assume that Disney is going to find a way to raise ticket prices, at least at the inflation rate. So I'm not assuming that they're going to build more people are going to come into the theme park, because that's a dangerous assumption, because you're going to overcrowd the park. The number of people coming to the park levels off in year 10, but after that, the cash flows grow at 2% a year forever. What does that buy me? It basically means that after year 10, I'm assuming the cash flows are going to have a growing perpetuity. And we already know what the present value of a growing perpetuity is. It's a cash flow in year 11. 715 million was my cash flow in year 10. There's the inflation rate, 2%. So my cash flow in year 11, divided by the difference between my hurdle rate, 8.46%. Remember, that's the rate we got after adjusting for the Brazilian country risk, and the 2% growth rate forever, which gives me a terminal value for this project. Terminal values is this fuzzy word of, this is what I think this project would be worth as a going project, as opposed to what? Many projects, you end the project after year 10, you get what's called a salvage value. What's salvage value? You shut the theme park down, you sell everything on eBay, including the rides and the pieces of the rides. Salvage value ends the project. Terminal value is a continuing project. So if you look at that cash flow, 11,275 million, it has now become the elephant in the room. Because if you look at the cash flows, those are my cash flows from the project for the next 10 years. But the bulk of the value comes from what I think this project is going to be worth at the end of year 10. I actually remember presenting this to a group of Disney finance people about 20 years ago. And there are two issues. The first was a very practical issue. They said, but projects don't last forever. Isn't this an extreme assumption to assume a perpetuity? I said, not really, and here's why. What if projects last 50 years after year 10? Let's say a typical theme park lasts 60 years. You know what if I did a growing annuity for 50 years, you know what this terminal value would have been? About 11 billion. So once you get past 50 or 60 years, you're very quickly approaching what you get as a perpetuity. In most discounted cash flow valuations, this is not the hill you want to die on. Well, you don't want to defend things last forever because nothing lasts forever. The argument you should make is if it's a long-term enough window, using a perpetuity is a good approximation of what the present value would be anyway. And if that person is really adamant that nothing lasts forever, bring out the growing annuity formula. It'll give you a value of 11 billion and move on because your value is going to be pretty much the same. The second question they asked is a much more intuitive one. And I think it's worth thinking about. What exactly does that number capture? 11,275 million. And I'll give you my answer, and you're going to see why this is the best way to think about it. It's what somebody would pay for this theme park if I sold it lock, stock, barrel, and Mickey included. You see why I have to include Mickey? Because if Disney tried to sell the theme park and pulled all its characters out of the theme park, nobody's paying 11.275 billion. This is the value that somebody would pay for the theme park as a going project with all of its assets in place. Which also means that Disney will never do this, right? There's no way Disney is selling a theme park to a competitor. So this is a hypothetical that we're answering, but that's what the 11,275 million captures. I'm almost ready. I've got my cash flows for the next 10 years, my terminal value at the end of the 10th year. I discount them all back at the 8.46%. Now, do you see why we sequence things the way we did? When I took corporate finance as an MBA, we did capital budgeting first. So we did all this discounting. And while we talked about capital budgeting, discount rates would come out of nowhere because we hadn't talked about discount rates. And the professor would say, we'll get to discount rates later. But I think it makes far more sense to get hurdle rates and discount rates nailed down. Because unless you know what you need to make on a project, how the heck can you do the mechanics of answering the question, is this project a good project? So you discount all the cash flows back. And don't forget the terminal value is also discounted back. What you get as a net present value of this project is $3.3 billion. Net present value is an extraordinarily flexible and powerful concept. Because it's not just a number. First, it tells me the project is a good project. That's the easy part. But let me ask you a couple of follow-up questions because you can see the power of this. If Disney takes this project, you know what will happen to Disney's value as a company? It'll increase by 3.3 billion. Net present values are additive, which means a company can be viewed as a sum of the net present values of the projects it keeps taking. So if you take a project with a net present value of 3.3 billion, your value increases by 3.3 billion. Doesn't mean the market cap will increase by 3.3 billion because the market might already have built in the expectation that you would take projects like this. But creating value is hard work. You have to find projects that make more than your hurdle rate and keep adding to that project base to increase your value. If you take a project with a net present value of 0, your value doesn't change. It's actually one of the most powerful concepts in business because here's what it tells you. I go out and take a $50 billion project with a net present value of 0. I become a bigger company, but I don't become a more valuable company. And if I take a project with a net present value of minus 20 billion, you say, why would I do that? In a minute, I'll give you examples. There are at least a couple of hundred cases like this every year across the world of companies taking projects with NPVs of minus 20 billion. What happens to the value of my company the minute I take that project? Or even tell people I'm going to take the project? My value is going to drop by 20 billion. You say, why would somebody be stupid enough to take a project with an NPV of minus 20 billion? First, how do you get a project that big? What kind of projects do you think deliver net present values of minus 20 billion, minus 50 billion, even minus 100 billion?
Movies.
I'm sorry, what?
Movies.
Movies. that'll be tough to spend. Have you ever heard of $100 billion, 100 million maybe, right? 100 billion is tough to do. Yeah.
M&A.
Acquisitions. Microsoft bought Activision on January 18th, right? In fact, one of the better acquisitions I've seen. Does anybody remember what happened to Activision's stock price and market cap the day the acquisition was announced? This is the easy half. It jumped by about 30%, by about 20 billion. It went from 50 to 70 billion. This is good, right? Did anybody keep a track of what happened to Microsoft's stock price and market cap that same day? It was down 2%. You think this is good. No, Activision went up by 30, 35%. Microsoft was down only 2%. But what's Microsoft's market cap? $2.5 trillion. What's 2% of $2.5 trillion? $50 billion. That might be an overreaction, but clearly investors are never as excited about acquisitions as managers are. And this is one of the better acquisitions. If you add up those two numbers, you actually don't even get a zero-sum game. It's almost like there's leakage happening in the system because of the acquisition. Here's my advice. Next acquisition, don't look at the target firm because it's never interesting. It jumped 40%, big deal. Look at the acquiring firm. And you're going to get, at least on the day of the acquisition, what the market thinks about the acquisition. In 60% of acquisitions last year, the acquiring firm's stock price went down, and went down substantially in the announcement of an acquisition, 60%. And through time, it's been the single best predictor of whether an acquisition actually works out. It's a noisy predictor. I'm not saying the R-squared is 95%. But of all the predictors you can make, whether an acquisition pays off, it's to look at what happened to the acquiring company's stock price at the time of the acquisition, because it's a net present value. That's what the market sees as the NPV of that project. The good news on Microsoft is it's recovered most of those losses. So I think it's done a good job of kind of framing the acquisition. A lot of times the loss happens and it continues. Remember the Eastman Kodak example that we talked about very early in this class. So NPVs have that nice feature of being additive. So when you look at the NPV for a project, it's a simple rule. If it's greater than 0, take the project. If it's less than 0, reject the project. It adds to your value as a company. And why does that matter? What's the end game in corporate finance? To maximize your value as a business. And NPV is a rule that delivers on that objective. But if you're a manager at Disney, you say, what does that 3.3 billion even tell me? Is that a good return? So I'm going to do an internal rate of return for this project. Now, the way we've all learned to do IRR now is with the IRR function in Excel. I'm old. I don't trust Excel on NPV or IRR, so I try to do it myself. That just might reflect that I'm just getting too old to be doing valuation. So here's how I do IRR. And it's actually going to give me the same result as what Excel gives when I hit the IRR function, or your calculator gives when you hit the IRR button. But I think it provides more information. What did I say the IRR was? It's that discount rate that makes the net present value 0, right? So my cash flows on this project, I can try different discount rates, 0%, 1%, basically, and plot out what the NPV will be on this project as the discount rate changes. For most projects, the NPV is going to decrease as the discount rate goes up. You think, isn't that going to be true for all projects? I'm going to let you think about the kinds of projects where as you increase discount rate, the net present value can actually go up. It's got to be where the costs are at the end of the project. So if you have a project where the licensing fee is due in 5 years, but you get to use the product for the next 5 years. But most projects, as the discount rate increases, as in the Disney theme park, the NPV decreases. So I keep plotting the NPV. And I look to see where the NPV becomes 0. And in this case, that happens around 12.6, 12.61%. At that discount rate, the net present value is 0. You're saying, this is a lot of work. Why don't I just hit the IRR button? Do you see what the additional information you get? This is called a net present value profile. We've got a graph. What is the slope of this line? tell me about this project. Tells me how sensitive my project is to changes in the discount rate. You're saying, why would the discount rate change? For lots of reasons. Interest rates go up, your discount rate changes. Risk premiums go up, your discount rate changes. In fact, when you take a project, one of your biggest worries in the world we live in is, what if things happen and make my cost of capital? It's right now 7%, go to 10%. This is not going to insulate you, but it tells you how sensitive your project is to changes in the discount rate. Now, if it's a standalone project, that might not be much use, but let's say you're comparing two projects, a Disney theme park and a big investment in Disney streaming, and I do the net present value profiles at both, and let's assume they both have the same NPV, but one has a steeper slope than the other. You probably take the project with a less steep slope because it's less sensitive to changes in your discount rate. In fact, if this were a fixed income class, and I computed the present value of a bond as the interest rates change, you know what the slope of that line would be called, right? Anybody remember from foundations? Or duration. Basically, it tells you partly you measure the convexity, so it'll tell you how sensitive the bond is at different interest rates. But as you go through, you're getting measures of duration. And in bond pricing, higher duration leads to more sensitive bonds, which are more sensitive to changes in interest rates. You're getting an equivalent concept here. So let's see where we are. You have a project with a net present value of 3.3 billion, good project. IRR 12.6%, higher than your hurdle rate of 8.46%, good project. But there's one thing that I did at the start of the project that might be troubling you. I did everything in US dollars, remember? And I said that's a bit of a, so basically the IRR and NPV both tell me this project is a good project. And as I said, we'll come back and talk about when the two approaches might give you divergent answers. But if you have a standalone project, NPV and IRR are always going to give you the same answer. If you're comparing across projects, they might give you different answers. But for a standalone project, you don't have to do both. Unless you want to, because they will always agree. But here's the thing I want to come back to. I did everything in US dollars. But I admitted up front that that was a bit of a fake, right? Because the cash flows are actually going to be in Brazilian reais. So I'm going to start with kind of a big picture question. If I had done all of this analysis in Brazilian reais instead of US dollars, would my conclusion have been different? Let me reframe the question. Should my conclusion be different if I change currencies? If it's a hot day in Fahrenheit, is it also a hot day in Celsius? Yeah, the numbers might be lower. Currency can't make a good project into a bad project or a bad project. If it does, there's something wrong with your analysis. And in 80% of projects, you see that when they change currencies, the NPV changes. We'll talk about what causes that in a minute. The question? Okay, so let's take that, right? So let's take this. If I switch to reais, inflation is going to be higher or lower? Okay, is that good or bad? On your cash flows, what's it going to do? It's going to create higher growth, right? On your discount rate, what's it going to do? It's going to increase your discount rate. So cash flows will grow faster. You're saying which one will dominate? Let's see. If you're doing everything in a currency, we talked about there's a consistency rule, right? If I do everything in dollars, my discount rate has to be in dollars, my cash flows have to be in dollars, my growth rate has to be in dollars. If I do everything in reais, my cash flows have to be in reais, my growth rate has to be in reais, my discount rate has to. If you do everything in Bitcoin, I don't even know what to say, but you know, you get the picture. Everything has to be consistent with your currency choice. So if I decide to do this project analysis in dollars, there are two things I need to do. First is my cash flows are all in dollars. I'm sorry, in reais. There are two things I need to do. First, my cash flows right now are all in dollars. I've got to convert them into reais. You're saying, what's the big deal? Well, I'm going to convert not just today's cash flows, but year one, year two. So you see what I'm going to need, right? I'm going to need expected exchange rates in the future. And if my cash flows are all in reais, my discount rate has to be in reais as well. Right now, my 8.46% cost of capital is a US dollar cost of capital. I've got to convert to reais. I'm not going to beat around the bush. Let's make those conversions. First, let's deal with exchange rates. You're saying, I'm going to cheat. I'm going to go look up forward rates. You could, maybe for year 1, year 2, but not for year 10. So I'm going to draw on one of the oldest theorems in exchange rates called the purchasing power parity theorem. You know what it says? If we have inflation rate of 9% in one currency and 2% in another, over time, the currency with the higher inflation rate should depreciate roughly 7%, the difference between inflation rates. In fact, even without futures and forward markets, I can predict exchange rates. And all I have to do is take today's exchange rate between the dollar and the real and adjust for the differential inflation. So what's it going to mean? I'll have to get more and more reais to buy a dollar each year as I go further into the future because the real is high. This has nothing to do with risk. It's all about inflation. And when I talk about discount rates, I've got to take the dollar cost of capital and adjust for inflation. And we've done this a couple of times before. 8.46 is a dollar cost of capital. I have the differential inflation. My real cost of capital is going to be 15.91%. It's kind of scary, right? You're saying, that's a lot of money I need to make. But I'm now going to do everything in reais. So here's what the numbers look like. There are my dollar cash flows. There is my expected exchange rate. And if you want to check out, basically I'm taking today's exchange rate and using the 9 and 2%. So basically, because inflation is so much higher in reais, I expect the real dollar exchange rate to go from 2.35 to 4.91. I multiply my cash flows by that expected exchange rate. I get a cash flow in reais. And then I discount back at my 15.91% real cost of capital. And here's the magic of all of these convolutions. If I do that, the net present value I get is 7,745 million real, which if I convert back to dollars at today's, because net present value is in today's dollars, gives me exactly the same NPV to the nth decimal point. And it shouldn't surprise you. All I've done is thrown inflation both into my cash flows and my discount rates. And if I do it right, my net present value should be the same whether I do it in reais, dollars, euros, pesos, whatever currency rate. Question?
Wow. When we say that, when we take that 1.9 by 1.02, we're making a prediction about.
We are not making predictions. That's exactly the point. Because if you have a point of view on exchange rates, that's making a prediction. Here I'm just saying, look, the fundamentals are what's going to cause the exchange rate to change. And I'm going to get the net present value on the assumption that I am not making a bet on exchange rates. You see why? If you have a forecasted exchange rate, it can drive your decision. Let's assume that you believe that in spite of the higher inflation in Brazil, that the real dollar exchange rate is not going to change over the next 10 years. You know what that's going to make you do, right? You're going to be taking a lot of projects in Brazil because you're making a bet on the exchange rate. It's got nothing to do with the project. And what I'm saying is you ask me to judge this project, I'm going to judge the project. If you have a point of view on exchange rate, you're welcome to bring it in, but it's a macro point of view. It has nothing to do with this project. I'm not going to make my net present value for the project higher because I think the real is going to get stronger over time. So when I do this, people say, but I have a point of view on exchange rates. I know. But on this one, I want to get the net present value for this project as pure as I can on the project. I'm going to focus on the project. And then you can bring in views about interest rates and exchange rates and whatever else you want. But remember, those are macro views. They have nothing to do with the project. And you're letting those views then drive your decisions. Yeah.
Just to confirm, we are saying that we are assuming that the macro situation will remain the same.
Oh, no, that's different. If you expect inflation to change over time, you can actually make the inflation rate change over time. That's a purely pragmatic thing. So I'm sorry, I misunderstood your question. So if you think inflation in Brazil is going to start at 9% and go to 4%, this process is completely flexible, right? You can basically have exchange rates change with differential. So you can make this process as complex as you want, as long as you base your discount rate and cash flows on the same assumptions about inflation, which is what you should be doing. the net effect is always going to be zero. Yep.
So in this case, so for example, we're projecting for 10 years forward.
Yeah.
If we use the inflation rate that comes from, let's say, a 10-year break-even rate.
For the US, that's exactly what I did, right? The problem in Brazil is it's tougher to get that, right? So often when people tell you about inflation, expected inflation in a country, you know what they often use? Last year's inflation. Yesterday, I was talking to somebody from Egypt who kept insisting that the expected inflation in Egypt was 10%. I said, how? He said 10.31%. He was actually very precise. I said, how do you know this so well? He said, because government told me that that's what the inflation rate was last year. First, do governments always tell the truth on inflation? But even if they did, you have last year's inflation, right? So expected inflation is what we need here, but often without the crutches of a TIPS and a treasury, which we use in the US to get differential inflation. You often use last year's inflation, but here's the good news. As long as you screw up in exactly the same way on your cash flows and your discount rates, being wrong on inflation is okay. That's a huge relief for me because I'm wrong on inflation all the time. But all I have to do is make the same screw up in both the numerator and the denominator, and I'm still making the right project decisions. So don't waste too much time projecting inflation. You have bigger fish to fry. You're a project analyst at Disney. You're not some macroeconomist who's got the rest of your life dancing around inflation numbers. You have to look at this project. I find analysts spend so much time on macro stuff that ultimately doesn't make a big difference in the micro decision on the project. So all I'm trying to do is keep the focus on the project. Any other questions on currencies? Now let's talk about the other big elephant in the room. When I made my projections, remember I was your number cruncher? What did I do? I looked at existing projects that Disney had and made my best estimates, right? Keyword is estimates. Could I be wrong? I don't even want to ask the, of course I could be wrong on every single input. My revenues could be too high or too low. My expenses, remember I used the 60 and 75% from existing theme parks. Who knows what this will look like in Rio? I might have to hire additional security. That might add another 5% to my cost. My tax rates might be wrong. In sum, every single number here is an estimate. And that makes us uncomfortable, right? As human beings, you want precision. And what I'm telling you is there is no precision when you're forecasting the future because you're not God. That's the basic problem. And for as long as people have been doing business analysis, they've wrestled with how do we deal with this uncertainty? So I'll give you some choices here. One is you could wait for the uncertainty to be resolved. What's the problem with that? When have we ever, I mean, take your lifetime, when have you ever had certainty? There's always degrees of uncertainty. If you wait for uncertainty to be resolved, you know when it's going to happen? Never. You're going to be holding a lot of cash for the rest of eternity. Second is you will not take the investment because it's uncertain. That's fine. Go run a money market fund. And even that has uncertainty. But if you run a business, uncertainty is not a bug. It's a feature. You got to deal with it. The third is, and this is what many companies do, is you outsource it. You ask McKinsey, what should I do? As if McKinsey has some crystal ball that tells them what's going to happen in Brazil. But this way, if something goes wrong, what do? You blame McKinsey. They told me to do that. The fourth is uncertainty might not faze you, in which case I have some serious issues about hanging out with you. You know what kinds of people are completely unfazed by uncertainty? There's actually a study that looked at very successful traders. Traders often don't seem to be the most successful, and serial killers. And they studied the brains of both groups. I don't mean to suggest that every trader is a serial killer, but their brain patterns were very similar. They were able to, because there's a certain, I mean, you almost have to be a sociopath of some kind. No, uncertainty doesn't bother me. I see complete precision here. So if you find yourself completely unfazed by uncertainty, become a trader, not a serial killer. I think that's a better choice. but maybe there's something you can do to at least make yourself feel more comfortable. And because I do valuations in my other class, and uncertainty is part of the game. It's something you'd have to deal with. I'll give you ways in which people have dealt with uncertainty through time, and you can take your pick. And remember, these are not about making your project choice better. It's about you getting comfortable enough to make a project choice. So here's the first thing you can do. This is perhaps the oldest way in which companies have dealt with uncertainty. What's the big deal about this project? You're spending a lot of money upfront, $5 billion, right? Wouldn't it be a relief if you at least got the $5 billion back? Because then everything you make is icing on the cake. So one of the first ways of dealing with uncertainty is to compute what's called payback. What's payback? I compute the number of years it will take you to get your money back. I can do it either in nominal terms, it's about 10 years, or in present value terms, 17 years. You're saying, what do I do with that? There are about a third of all companies have payback restrictions. They will not take projects that have a payback that exceeds 5 years or 10 years. They need to make their initial investment back in a certain period for it to even be acceptable. It's kind of a rough way of bringing uncertainty, saying, look, I want to make my initial investment back within 5 years. And if you have a project that takes 12 or 15 years for that to happen, that's too long for me. And there's actually a logic to that, right? If you're in a business where technology is shifting, you start a streaming investment, and I tell you to take you 12 years to get back what you've invested in Disney streaming, Disney should be freaking out. Because who knows what the streaming business will look like in 4 or 5 years? In fact, in technology-driven businesses, you're going to want to have your payback pretty quickly because if you have to wait too long, the technology might shift under you. So that's a simplistic, but for some people, that's enough. That it's a big project, I get my money back in 8 or 10 years, and then everything else is icing on the cake. So all that requires is adding up the cash flows till you get to a cumulative cash flow of 0. But especially in the last 40 years, the tools we have for dealing with uncertainty have become more powerful. So here's the second, and this kind of goes with Excel spreadsheets. Is you do your project analysis, you come up with an NPV. And this is going to happen on the case. And somebody says, what if we change this? What if we change that? And remember, in the days before Excel spreadsheets, people were much more reluctant to ask those questions because it took a lot of time to deal with each question. I did my MBA between 1979 and 81. And summer, for my first year MBA, I was looking for something to do during the summer. It was one of the worst recessions of the last 100 years in the US, in the middle of the Volcker, cracking down inflation. There weren't very many jobs to get. And I managed to get a job at a company, I won't even call it a company, at a business called Watermark. It's no longer around. But it's a business that made radio shows. In fact, at the time that they hired me, they had one radio show that they syndicated to radio stations. You know what syndicating a radio show is? They make the show, they sell it to radio stations, and the radio stations pay them $1,000 a week so they could just play it on the station. The show is still around. It's called American Top 40. And right now, I don't know who the host of it is, but you drive cross country anywhere in the US on a Sunday, you turn on. It's a very simple concept. You've heard it? They start with the number 40 of the list and work all the way down to 1 with some chat in the middle about the artist. So there'll be little stories thrown in. So in 1980, their money was coming from American. They had, I think, syndicated like 520 stations. It's one of the most widely listened to shows. 520 times 1,000 is 5. So they were making a fair amount of money from this show. So you're saying, why do they need to hire you? They were considering a second show called Soundtrack of the 60s. Completely revolutionary concept. You know what they were going to do? This is 1980. They were going to go back to 1960, same week in 1960, take the top 40 songs from then and go down the list. So I was hired to do the capital budgeting on the show. Remember, this is 1980. The K-Pro, which was the first computer with a spreadsheet on it, hadn't even come out. There was no Excel, there was no Lotus, nothing. So I remember I go into the small office. It was in San Fernando Valley somewhere. near Universal Studios. I walk in and it's like 15 people working around the office. And I said, look, I'm your new summer intern and I've been hired. Can you show me the CFO's office? I'm supposed to talk to him. They show me a little cubicle. He had a bigger cubicle, but it's still a cubicle. He's the CFO. And I asked him, what am I supposed to do? He said, you have to do the project analysis and soundtrack of the 60s to tell us whether it's a good show. Now, I have one corporate finance class under my belt. Every project I've ever seen comes with cash flows and discount rates. So I asked the CFO, can you give me the cash flows in the project? He hands me a blank ledger sheet. So that's your job. So, okay, it's quite a challenge. And I tried, but this was like pulling teeth. Why? This was a creative company. Have any of you worked at creative companies? You know what happens to people who talk about numbers at a creative company? You get treated like the devil. You're getting in the way of the creative instincts of people. How dare you ask how much something costs? I remember I stood out, to analyze the show, what's a fundamental number I need? I need to know how many stations would subscribe to the show. I know nothing about radio. So I went to the marketing head's cubicle, a little smaller than the CFO's cubicle. And clearly he didn't like me. He acted like he didn't see me for like 4 days, even though I'm standing right there. And finally, probably got tired of me getting in the way of him getting to the coffee machine. So what do you want? I said, you know what? I have to analyze this new show you're planning to do. How many stations do you think you can sell this show to? He said, I don't know, 400, 600, 800, something like that. And I knew that was all I was going to get from him. So you know what my base case was? 400, 600, 800. I went right down the middle. 600 stations. So basically every single line item, I'm just taking grasps of little pieces people are giving me and building a spreadsheet. So 8 weeks later, I'm done with this ledger sheet. It's not a spreadsheet, but a ledger sheet, every number. I did it in pencil, something you learn very quickly when you do things on a ledger sheet. You do everything on pencil in case you screw up, which you will. And I finished, I come up with the net. I'm very proud of myself. So I go back to see if I'm ready to present. He says, let me call the CEO and a couple of the directors. We sit around a coffee table. This is not some elaborate office. And I present my numbers and I come to the climactic moment in my presentation. Based on my analysis, the net present value I get is minus 35 million. You shouldn't take the project. They look at each other and say, what would happen if you tried 800 stations? My stomach drops. Because on a ledger sheet, changing 600 to 800 means every single number has to be redone. And I said, the NPV will probably turn positive. They said, try 800. I said, why would you want me to do that? They said, we've already decided to do the show. We just want you to confirm it for us. I thought at that time that this was very unprofessional. I thought this must be a small business. They're so unprofessional. I've learned in hindsight that in most businesses, when projects get analyzed, it's not to decide whether the project should be taken. Somebody's already decided that for you. They just want to make sure that they can cover their rear end by showing that there's an analysis that was done, usually after the fact, to justify the decision that's already been made. It's like Alice in Wonderland, where Alice wanders in the Queen's court and she says, verdict first, trial afterwards. The decision predates the analysis. So when you do your analysis of a project, you can ask what if questions. Sometimes because you really are curious about what if, sometimes because you don't like the answer you got. And you want to say, what can I change to get to the answers I expected to get? And I think it's become far too easy to ask what if questions. That sounds like a strange thing to say, because we have so many tools at our disposal. So this project that you're doing, I've done variants of that project every year I've taught this class. And every year I beg people. Remember, I have to read every single project. So I'm going to beg you now, please keep it brief. I don't want to read elaborate theses about restaurants or about building supply businesses. I want something that is basically tailored to what I'm asking you to do. Should I take this investment or not? And most of the time, people listen. But I remember about 15 years ago, there's a, people, I forget the project that year. I had 80 projects finally from the class. 79 of them were 10 pages or less. They kept to my instructions. And one project stood out. It was like this hefty book, 150. So I said, what did these guys do? They'd taken the project and asked what if questions about everything under the sun. They'd run 105 different scenarios. What will happen if the federal chairman in a Fed chair gets a cold? Okay, let's compute the numbers then. You think this is good? They asked a lot of what if questions. But here was remember, your job on this project is to decide whether to take the project or not. Here's what that project's conclusion was. We've run 105 scenarios. In 55 of these scenarios, we got a positive net present value. In 50 of the scenarios, we got a negative net present value. We're too confused. You make the decision. And unfortunately, that's what often happens with what if analysis. You think you're going to converge on some decision, but instead of converging, you diverge. Keep that in mind. When you ask what if questions, your focus should still be on how does this help me make a better decision? Not how do I add more exhibits and scenarios. So if you're looking at your project and you want to ask what if questions, keep it minimal. Pick 2 or 3 big assumptions and ask what if questions. Don't get distracted. And if you can, rather than churn out table after table of additional numbers, see if you can take what you find from your what if and present it in a way that helps decision makers, helps you make a better decision. A picture is worth 1,000 words. And by picture, I don't mean create chart in Excel, because you can create charts of pretty much everything in Excel, but creating charts that actually convey information. So I'm going to give you a reference. I don't reference too many books. One of my favorite books is a book about actually presenting quantitative information in charts. It's written by a man called Edward Tufte. I don't know whether he's still teaching. I think he used to teach at Princeton or Yale. And his specialty was how do you present information in pictures? So one of his first books is called Quantitative Display, Visual Display of Information. I'll send you the link. It's about a $10 book, well worth the money, because he shows these pictures that have conveyed a story and information in creative ways. And here's one of my favorite pictures. It's a picture of Napoleon's ill-fated expedition about 200 years ago to invade Russia. Through time, I don't know what it is about Russia, for whatever reason, big European monarchs get in their head, they want to invade Russia. So Napoleon wakes up one day and says, I'd like to invade Russia. He gathers this huge army. There it is leaving France. So the width of that line tells you the size of Napoleon's army leaving Paris. And he's marching across Europe. It's a long way to Moscow. Remember, these actually are soldiers walking. Napoleon's on a horse, obviously, but everybody else is walking. And it's going across there. You're saying, why is it getting smaller? Because people die along the way. It gets, You're saying, what are these little things? That's when they get distracted and invade Poland along the way because it's in the way. So basically it's, and they keep marching and marching. And as I said, it's, Russia is a big country. So notice as they're going through, and in this picture, they also put a graph of the temperature as they're marching through. So as they're marching, it's becoming winter. Winter in Russia is not a pleasant place to be walking. By the time they get to the outskirts of Moscow, the army is about 1/3 the size of what you started with. In fact, if you go to Moscow, there's actually this arch where Russians claim they stopped Napoleon. The truth is that Russians didn't stop Napoleon. The weather stopped Napoleon because he got there in the middle of winter. It's freezing cold, and he says, I want to go home. So he turns around and starts marching back. But remember, it's still winter and marching back. And so by the time he gets home, it's 3 people carrying Napoleon into his castle or wherever he left. This is a great graph. It tells you what people spent hundreds of pages writing about this ill-fated expedition in one picture. Have you heard of Tableau? This is a company that visualizes information. It's actually it's a public company now. If you get a chance, get on the website because you can get a subscription to it. It can be expensive. But Tableau is a company that basically says, look, Excel charts are a terrible way to present information because there's not much there. You can make a 3-dimensional chart, a 4-dimensional chart, but it's still a chart that doesn't reveal what you want to. Think of creative ways of presenting information, because people don't have the time to read 100 pages now. They don't have the time to go through 10 tables, but if you can present it in a visually gripping way, the same information can be presented. Don't spend too much of the time on this case trying to do this chart, but I'm saying in general, think about more creative ways of presenting information. So you can do break-evens, or payback periods. You can ask what-if questions. But in the last 15 years or so, there's a third tool that's opened up. This tool's been around for a long time, but 40 or 50 years ago, if you wanted to use this tool, you'd have to pay millions of dollars and get a mainframe computer. It's called a Monte Carlo simulation. Sounds fancy, but here's what you do. Remember when I did my theme park analysis, for every assumption, I made a point estimate. You know what a point estimate is? A single number, my best expected value, 60% as cost, revenues of a fixed number. And as I was doing that, my insides were screaming, saying, but I could be wrong, I could be wrong. A Monte Carlo simulation lets you bring that scream out and say, tell me how wrong you can be. So what it does is, instead of giving you one number, I give you a distribution. So let's take examples. I gave you revenues based on what I saw at other theme parks. But this is very different. It's in Brazil. Who knows what will actually happen? Maybe my revenues will be higher than expected, lower than expected. So basically, I let the actual numbers be anywhere from 80% of my estimate to 120%. And because I'm completely blank about what the uncertainty, this is called a uniform distribution, anywhere from below 20% to my estimates to above 20%. On the operating expenses, I use 60% based on Disney World and Disneyland, but who knows what that will be in Brazil? Maybe it'll be lower, 45%. So basically, again, with each assumption, that's called a triangular distribution. And finally, I am worried about country risk. Think of how quickly the equity risk premium for Russia at the start of this year was about 2.5%. The equity risk premium today is about 20%. I know ESG is claiming credit for companies leaving Russia. You know why companies are leaving Russia? Because of the 30% cost of capital, nothing is worth continuing in the country. Maybe they're doing it because of good intentions and for being good, but the reality is become uneconomic to run a project with a 20% equity risk premium. So with the country risk premium, I built a distribution, and here I went with the classic bell curve, normal distribution. You're saying, why can you do this now? And you couldn't do this 40 years ago. I used a product called Crystal Ball. In fact, you have access to it at Stern. It's free if you're a Stern. So if you go to, I don't know, where apps or wherever it is, you can find these things. You can download it. And essentially, it allows you to take any Excel spreadsheet you've already created. So you don't even have to think about it till you're done with your base case. And put this on top. The only problem is if you don't think through the inputs for this, it's garbage in, garbage out. It's great looking garbage. But this requires you to think about what is the, so rather than best or worst case, this fills in the middle. So you're saying, what's the end product here? In a simulation, here's what happens. The computer goes and picks one outcome out of each distribution. In fact, within Crystal Ball, you can put in correlations. You can say, if my revenues are higher than expected, my expenses will be lower than expected because of fixed costs. You can actually tie them together. So it picks a revenue number, an operating expense number, a cost of capital number. And it comes up with the net present value. And it does it over and over. How many times? Crystal Ball's default is 10,000 simulations. It takes it like 7 seconds to do. I like to set it to 100,000 simply because I like to see, you can actually see the graph in front of you as it runs these simulations. It's kind of neat. 1 minute later, here's what you get as output. You get a distribution of net present values. You say, what do I do with this? Well, you can take the median value, which is 3.3 billion, which is very close to what we got. There is all this work and I'm getting the same number, but I'm going to give you additional information. Remember, people do best case, worst case. What a waste of time. I'll save you the trouble of doing best case, worst case. In best case, your project is worth a lot. The worst case, it's worth nothing. Why do that, right? Basically, the simulation fills out the middle. It gives you the 10th percentile, the 20. In fact, if you look at my valuation for the FANG-AM stocks that I did 3 weeks ago, I came up with my median value, but then I tell you, this is my 10th percentile, this is my 25th. That's what simulations allow me to do, is fill in that distribution. So if you look across the net present, and it also tells me the percent of the time I could be wrong. I did all my homework, but in spite of doing all of my homework, there is about 12% chance that this net present value could be negative. I think companies and investors need humility when investing, which is you can do everything right, but if something happens that's out of your control, your net present value can still be negative. Now, am I going to reject this project because I'm going to leave that choice to you? Let's say I did this simulation. I come back to you and say the median value is 3.3 billion, but there is about a 10% chance the net present value could be negative. Should you reject the project because of the 10% chance? If you do, you are risking double counting risk, right? You put in a risk-adjusted discount rate. But if you have choices, let's say you have 50 projects, you can add second layers, right? You can compare the NPVs, you can look at the likelihood of failure. You can also look at how big failure can be, because some projects, if things go bad, you could lose 7 or 10 or 15 billion. You're saying, why do I care? If you're a small company with limited capital, you might not want to take a positive net present value with a really negative tail, because that could put you under. I think you can make your decisions richer. We don't do this because we get great looking charts. We do this because it might help us make better decisions. I'll tell you the other way it can help you. If you can get a sense of what's making your NPV negative, maybe it's because your wage costs in Brazil are too unpredictable. There's something you can do to actually make that less of an issue, right? You might be able to enter into long-term contracts with unions where your wages get more predictable. So it's not just about making better projects, but running these projects better in the aftermath. Any questions about payback or sensitivity analysis or simulations? Yes.
My question is, for your input, you have like 3 different distributions.
There are actually 52 different distributions.
How do you choose which?
You know. Well, before you choose them, you got, first time you look at Crystal Ball, you look at those 52 distributions, your reaction will be, what the heck is that? Bernoulli, never heard of the guy. Log normal, I don't even know what that is. I actually have a 15-page paper on my website. It's not really a paper. It's about how to pick distributions. Now, I wish statistics classes actually gave you those tools, right? Because that'd be nice. We came out of statistics understanding left skewed versus right skewed. And how do you pick a distribution? So I'll send you that link as well if you're interested in learning enough about the distribution that you can make a choice. So it's a combination of understanding statistics and using data. So for, one of the things Crystal Ball allows you to do is actually use real data for distributions. For interest rates, I can take the last 100 years of interest rates, look at the percentage changes each year, make that my distribution for next year if I trust past data enough to do that. So it's a very rich program. And as I said, we're lucky to be able to have it as something everybody can use. It is a little more expensive when you're not a student. I think it's a few $100s. It's an Oracle product, but you can go on the Oracle website, download the free version. But at some point in time, if you work with a lot of numbers and uncertainty is the rule of the game, where in the place that you work, if you work at a technology firm, lots of uncertainty, it's well worth bringing these tools into play. So that's the Disney theme park. I'm going to switch gears. The Disney theme park, the cash flows I looked at were pre-debt cash flows, right? No interest payments, no debt payments. The discount rate I used was the cost of capital. The investment I looked at was the total investment in the project. Now I'm going to look at how the numbers would be different for a project when you take the equity investor's perspective. First, when you think about returns, you're not going to be looking at returns on invested capital. You're going to be looking at returns on equity. When you think about hurdle rates, you're not thinking cost of capital, you're thinking cost of equity. And when you're thinking cash flows to equity investors, it's cash flows left over after interest payments and after debt payments. So let's say I put my equity investor's hat on, and I'm going to take a project. There's too many words on this slide, so don't even try to read it. I'm going to take an iron ore mine that Vale is planning to open or planning to invest in or thinking about investing in Canada. So let me go through the details. There will be an initial investment of 1.25 billion in the mine. The mine has a capacity of 8 million tons of iron ore once established, and that investment of 1.25 billion is going to get depreciated straight line to a $250 million value. There's no terminal value here because once you get the iron ore out of the mine, it's not like you can keep running the mine forever. So it's a very different perspective. You're basically running the project in. At the end of the project, you get whatever you can for the land, if anything, it's $250 million. The mine will start production midway through the next year, and it'll build up. It'll initially produce only 4 million tons, but as you go through time, your capacity will build up to full capacity, which tends to be true about manufacturing and mining, is you don't go to full capacity right away, but it'll affect your revenues and your earnings. In terms of cost, there's a variable cost of production. That cost in constant dollar terms is $45. What does that mean? Well, if there's inflation, the cost will go up, but that's per ton, that's the cost. And there's a fixed cost of 125 million, which will also grow at the inflation rate, but it's a fixed cost. It's not a function of how much you produce, it'll stay at 125 million. The cost will be in Canadian dollars, but I'm doing everything in US dollars, partly because it's a commodity company and they report in dollars. But we'll talk again about what will happen if I did it in Canadian dollars, and the answer is going to be not much. And finally, in terms of working capital, it's going to be 20% of revenues, and the investments have to be made at the beginning of each year. So if I made it at the end of each year, which I did in the case of Disney, the cash flows happen at the end. Here, I'm going to make it the beginning, which means it'll be at the end of the previous year, because I've got to get ready for the next year. The tax rate of 34% is the Brazilian tax rate. It's a marginal tax rate. Now, here's where I'm going to switch gears. That is my description of the project. But Vale is going to borrow $500 million of that 1.25 billion. The remaining 750 million is going to come from equity. And it's going to pay off the debt with a term loan. You know what a term loan is? If you have a home mortgage, the old-fashioned home mortgage, 30-year mortgage, you won't borrow money from the bank actually gives you a fixed payment every month for the next 30 years. But a portion of the payment each year is each month is interest, and portion is principal. A term loan, the payments you make each period are the same, but the composition of the payments will change over time. In what way? It's actually fairly simple to compute. Here, I've actually taken the total payment. The total payment is 61.8 million. That's a term loan. And broken out how much is interest and how much is principal. And you're going to notice a pattern, which is always going to apply in term loans. Early on, if you look at how much is interest and how much is principal, there's a lot more interest. But as you go further and further through, it becomes a lot more principal. Why? Because there's less money left over in the loan. If you ever take a home mortgage, again, the way this shows up is in your tax deduction. Because remember, you're allowed to deduct only the interest portion of your payment. So when you get your tax statement from your bank on your mortgage payment, it'll tell you this much is interest, you can claim it on your taxes, but this much is principal repaid, you can't claim it. And guess what? As you go from the first year of the mortgage to the 30th year mortgage, the deduction you're going to get is going to get smaller and smaller because less and less of it is interest. You're saying, why even bother? If you're going to pay out 61.8 million, why do you care how much? Why do I care how much is interest and how much is principal? For the same reasons you did with the mortgage, right? The interest portion is tax deductible. The principal portion just comes out of my after-tax cash flows. So here's what my final key component here is. Here I need a cost of equity because I'm doing everything in equity terms. And because I'm doing everything in dollar terms, it's got to be a dollar cost of equity. So I went back to the Vale numbers and I came up with the dollar cost of equity of 11.13%. That includes whatever risks I think Vale has as a company. It's all built in there. I'm going to use that 11.13% as my discount rate for this project because I'm doing everything in dollar terms and it's an equity cash flow. You see, I could have taken the same project and done it in terms of reais as a pre-debt, in which case I'd be using a real cost of capital. So the choice you make about discount rates is framed by how you think about your cash flows and how you're estimating the cash flows. So when we start next class, I'm going to go through the NPV calculation for this project with a completely equity mindset. It's trickier because you're going to be focused only on what you bring in as an equity investor, what you get out as an equity investor, and you discount back at the cost of equity. So we'll talk about that on Monday, but in the meantime, we have obviously a lot of work to do in your project. So hopefully you get it through, and if you have any questions, I've office hours today, and I'll add another office hour through this weekend in case you have questions specifically about the case. And yes. Oh, sorry. Yeah.
Real quick one, Professor, about the net present value, the terminal value in the case. It mentions the investment period is 10 years, so we are opening stores for 10 years. But nothing is, at least our group couldn't find information about what to or how to factor in terminal value. Are we going to cover that in next class, or?
It's up to you, right? There are two scenarios I have to look at. What will happen if you're running this project for a finite period, the 10 years? What will be different? It's up to you. You can decide, that you're going to run the project for an extra 10 years, an extra 15 years, in which case you use a growing annuity. Because it's not given, right? It wouldn't be given in the real world. I'm not going to give you any information that the real world wouldn't give you. So when you look at a project at a company, nobody comes in and says, here are the terminal value assumptions. I'm sorry. You have to make your best judgments given the kind of project it is. So that's intentionally left. So if any information is missing, same thing with capital maintenance. I gave you no information because I want you to make the assumption based upon what you assume. So the assumptions that are left out for a very simple reason. It's because I want you to make those assumptions.
Thank you.
Okay.
Yeah. I do have a question about, well, it's related to what you said about the negative NPVs.
Yeah.
And I'm connecting it to the case when you talk about spillovers and when you have opportunity costs. So
they should all be incorporated into cash flows, right? So
but just
it'll still be the consolidated NPV you're looking at for the decision, right? So if you have a project and it's got side benefits and side costs, there's no point having 3 NPVs. Ultimately, you can either take the project or not. So you can do the 3 NPVs, but the final decision has to be made on the consolidated NPV, which is the NPV of the base project plus the NPV of the side benefits, which will push the number higher, minus the NPV of the cost.
So negative NPVs wouldn't, you wouldn't accept it because of spillovers effects, because the spillovers would already be
exactly. That's why the final number should already have the spill, because you're not leaving the spillover as kind of a buzzword. You've actually computed a net present value of the spillover.
Okay, but then I don't get how would you accept a negative NPV? In what case would you accept a project?
Never if you're looking at a consolidated NPV, right? Because you're looking at a consolidated NPV, you've already brought in the side benefits. The reason people accept negative NPVs is because they don't quantify the side benefits and the side costs.
Okay.
That's the garnishing part, where they say the NPV is negative. Oh, by the way, there'll be people buying more stuff at our stores. Therefore, we'll take the project. But if you don't quantify, that's exactly where you're going to end up, right? It becomes an excuse for doing what you wanted in the first place. And that's why I push you to quantify these numbers, because once you quantify it, you can tell me what you don't like about my numbers, but you can't wave your hands and say, just take the project, good things will happen to you.
Understood. Understood. Perfect. Thank you.
Yeah.
I have a question about hurdle rates.
Yeah.
And particularly, so for example, in the project, losses going from purely US to an international mix. Does that mean each year our hurdle rate changes?
What part of the hurdle rate is changing each year? It's not the mix of countries doesn't change each year.
No, not our stores change each year because we're opening more stores internationally.
But don't I tell you the mix is the same over time of the new stores? If you were opening only US stores for the first 5 years, and all the Asian stores were opening up to year 5, you're absolutely right. Your hurdle rate will change. But in the project, I give you the geographical mix of stores, but I also tell you that geographic mix is stable over time.
Yeah, but that's for the new stores that open.
Oh, you're saying for the old stores? It's not worth it, right? It's for the first 2 years and then the numbers. But if you wanted to change it to reflect the different equity risk premiums, I'm perfectly okay with that.
So I suppose, for example, in a hypothetical scenario, if we are looking
If
at
it
a
were
company
big
that's going
changes,
from
where, for
pure US
instance, you're
to
just
international.
US stores for the next 10 years, and then you're going to open stores in India after you're 10, then I think you really need to work to change it because it has a much bigger, remember the biggest number here is your terminal value, right?
Yeah.
So if you're using a different discount rate in year 1 and 2 and 3 is not going to make that much of a difference in your
Oh,
NPV.
that's true. Yeah.
So from that perspective, you probably, it's not, the NPV is not going to change that much.
It's not worth the effort having.
It's not worth the effort of
discount rate.
finessing it.
Okay.
Yeah.
Thank you very much.
Okay. Hi.
I'm Steph, by the
Hi.
way.
Yeah.
Just quick question.
Yeah.
So I downloaded the Bloomberg terminal, and like it's a little bit difficult to navigate. Do you have any webcasts where
You're able to open the terminal
Yeah,
through,
I
so you're
can
using
open it.
Bloomberg anywhere, right? So
Yeah,
you open it.
I think just like trying to understand all the different functions and everything. I didn't know. if
I
you
sent a
webcasts.
link to a packet that I put together on using Bloomberg, and did you get that?
I did, but there were some things where like I think it was like ERC something. Like
Yeah.
I tried to search for it and I didn't, like nothing was coming up. So,
What
like,
were you looking for?
I forget that. I started with an E, and it was I like honestly I forget, but it was.
Did you find your company? Because much of the data in Bloomberg. Okay. So this is some macro stuff you were looking for on
Yeah,
Bloomberg.
I
that
need you to look for like the different industries in it. I forget the function, but I was just like,
Oh, the function
I
where you do
just
the
did-
equity search function, ESRC maybe?
yeah.
Yeah.
I did that one.
Don't use Bloomberg for that. It's very tedious. Use the S&P Capital IQ, because if you're going to look for companies in a sector, it's easier to work with Capital IQ because it lets you download to Excel.
Okay. Okay.
So anytime you want company, sector-wide information, S&P Capital, Bloomberg is better for getting numbers like trading volume and who holds shares in the company, things which are kind of updated and current.
Okay.
S&P Capital IQ is much better for the kind of data you want across companies, lots of different companies. There is an equity search function. In fact, they might have changed the wording for it. But basically, it's really difficult in Bloomberg to navigate that function and find what you want, because I guess very few people use the function. They've not finessed it.
Yeah.
But S&P Capital IQ is much easier to do.
S&P Capital IQ, is that, do you have to download that or anything, or just?
No, just you just have to get access to it. So it's
Yeah.
basically,
Yeah, I can show you that.
yeah.
It's similar to Bloomberg. You have to find it.
It's more powerful because it has past data. So if you want last 20 years of earnings for your company, you can pull that up. So basically,
It's a
any.
little more intuitive. It's not like, so it's similar to Bloomberg because you're cut access to everything. You just create an account and then download the. Is that, I think you got all that through like I don't think you actually have to be granted access, but.
S&P Capital IQ is a general database, but it'll ask you for a username and a password.
Yeah.
And NYU, because NYU has access to the database,
Yeah.
they will let you access the data. So you have to get that permission. It's not a big deal. It's like if you want, email me after. I'll send you the little document on how to get S&P Capital IQ.
Okay, I'll send you an email. Thank you so much.
You're welcome.
And thank you. Yeah, I had a question about NPV. You're saying
Yeah.
it's additive to the value of a company, but not market capitalization. What?
Because
value-
markets are building expectations,
Sure,
right? So
sure.
if I think you're going to take great projects for the next 20 years, each of which
You-
is going to
you
have
would
20 million, I'd
anticipate
already
to-
anticipate and build it
So
in.
what value metric is it additive to? Is it book
To your
value?
true value. Because remember, price is what the market attaches. Your
Right.
value is basically what the value of your company is based on your cash flows, your growth, your risk, right?
Okay.
So if I think about valuing your company and I bring in the cash flow and you never take a project, then basically your cash flows, growth, and risk will never change. Your value will never change.
Right.
The price might go up because they think you're going to do this, but ultimately the price will have to reflect the reality, which will come down to value. So
What metric of value is that?
It's based on, so if you take,
Like comparable?
no,
book
that's
value?
pricing,
Okay,
right?
pricing. Okay.
Value is based on cash flow. So basically, just like we did the
NPV
NPV,
of the
think of the
company.
NPV
Oh.
of a company, right? So
Is
NPV of a company.
additive. Okay, that makes
So-
sense. And
so-
then, but I mean, with the interesting with Microsoft and Activision, when you're discussing beta before and discretionary, non-discretionary businesses, Activision has a higher beta than
Right.
Microsoft. So like, I think that would be a way to rationalize the acquisition.
But then nowhere value can ever be gained by buying a company with a higher beta or a lower beta, right?
Because it would then change your beta.
But
Microsoft's beta.
that's not value changing, right? It's just you'll end up with a weighted average beta reflecting the different values. There's no value increase that happens to Microsoft because the combined beta will be different after the acquisition.
Okay.
Value can never be created by having a lower beta after an acquisition or a higher beta after an acquisition. All it does is it takes a combined
Change the
company and
cost
says,
down.
so basically I'd get exactly the same value for the company using that weighted average beta.
Uh-huh.
So it's all about what you paid for the company relative to the cash. So think of Activision as this gigantic project that Microsoft is taking.
Right. And the company like Microsoft.
Yeah. So basically, Microsoft might have all kinds of plans on how it's going to use it to enter the metaverse. Let's say it puts those cash flows in because it can use Activision as its entry point. So like the Disney theme park, then you'll have cash flows and Activision in Microsoft's custody, and then a terminal value at the end of year 10. Then I discount them all back to the present. I get a value for Activision given Microsoft's plans. Then I look at what Microsoft paid for it.
Yeah.
And if you paid more than the present value of your cash flows, that's like taking a net present value, negative net present value project. So I'm allowing Microsoft to give me all its synergy dreams, building into the cash flows and saying, look, guys, you still paid too much. That's what the market would say. Now, of course, markets can be wrong and Microsoft might prove them wrong, but at least at the moment, people are skeptical about how much value Microsoft can create out of Activision. But to give you history, Microsoft, when it bought LinkedIn, that was viewed as kind of not a great investment. Microsoft has converted LinkedIn into something that's value adding now. So it's not that it's hopeless, but basically people are saying, show me.
Okay.
Yeah.
And I guess with the beta thing, it's just offset by the
There's nothing, yeah, basically it's hey, if you have two projects, one is a beta of 1 and the other is a beta of 2, you do the net present values of the two projects. And then you take the combined project, nothing changes, same cash flow. So that's combined cash flow. You take a weighted average beta, you get exactly the same NPV for the sum of the two projects put together as you did before. There's no value creation or value destruction from just combining two businesses.
Okay. Thank you so much.
Perfect. Quick question
Yeah.
on the project.
Yeah.
When we're getting down to like the NPV, should we be factoring in the interest?
It's a choice you have to make. That's the equity approach, right? So there is no should, right?
So the point is we can do it on either an equity FCFE basis, or if we do it on a unlevered free cash flow, we just wouldn't include interest.
And the discount rates are going to be different.
Right. And we can do either one. It should get the same
Either
answer,
way, you
right?
should get the same answer.
Yeah.
You have to decide which one's more work. I think adding the interest payments and the debt, it's not just interest, right? You got to figure out how the debt gets repaid and what new debt gets taken on. It's not as simple as just taking the interest payment out, right?
Right. I guess it would be like a whole debt schedule.
Yeah, you have to do a debt schedule.
So I agree. So probably unlevered would be easier.
Yeah. It's not unlevered because you still have the leverage effect in the cost of capital, right? But it's unlevered as in the pre-debt cash flow.
Yeah. Okay. Thank you.